Everyone, in today's video, we're going to be talking about Roth conversions in relation to moving to another state in retirement. Now, there are a lot of retirees that move to another state, and there are a lot of reasons to move to another state. Some of those reasons are you're in a high income tax state, and you're moving to a state that's a little bit more tax preference. Some retirees live in some cold states that have some cold winter months, like up here in Wisconsin, and want to move to a place that is a little bit warmer in the winter. Other retirees are moving to be closer to family. And all of these are completely valid reasons and cause a lot of retirees to move. And so we're going to talk today about how to integrate your tax planning and coordinate that with this move. Now, if this is your first time on our Safeguard Wealth Management YouTube channel, or maybe you've watched a few of our videos but are not yet subscribed, we release videos weekly on how to build a better retirement plan, how to get more from the assets that you already have. So if that's something that interests you and you like some of these videos, hit the subscribe button. We release, again, videos weekly. You'll be notified of all future videos that we release. So let's get into it. So state income taxes, the taxes that states subject you to, varies widely. Okay, as you'll see on the screen here, this is for 2021. This is the top marginal individual income tax rate in each state. What you'll notice is the darker red that these states get, the higher their state income tax. The lighter yellow, the lower their state income tax. And then the gray states have no income tax, meaning that if you're taking withdrawals from an IRA, the state won't tax you on those withdrawals. Okay, and state taxes vary widely. Again, they're a changing thing. This might look totally different going into 2022, which makes this picture that much more complicated and makes it confusing for a lot of people to keep track of. Okay, so let's talk about the added cost to a conversion depending on what state you live in if you're planning on moving to another state. So we're going to use an example here of somebody living in Wisconsin. Again, you can kind of apply this to your state if you live into a slightly different state and have an idea of what your state income tax brackets look like. But let's take a situation where somebody's moving from Wisconsin to Florida. Okay, so they're moving from a state that has a relatively high state income tax to a state that has no state income tax. So if you perform a Roth conversion, your state will tax that Roth conversion. That is a taxable event. Okay. And so let's say somebody's maxing out the 22% bracket. They're married in Wisconsin, and so they're going to be doing a $90,000 conversion for where their taxable income was at. Okay. Now they're going to be in the 22% bracket, obviously, if they're maxing out that 22% bracket. And so the math's pretty simple on that. 22% of 90,000 is almost 20,000, 19,800. Okay, so at the bare minimum, that's the federal income tax that they're going to owe on that conversion. You can't really escape that unless potentially you move out of the country and follow a whole different set of complex rules. Okay, but then on top of that, if they perform this conversion while still in Wisconsin, they're going to owe Wisconsin state income tax. Now, they're going to be in the 6.27% Wisconsin state tax bracket, which means they're going to owe another $5,643. Okay, so their total tax rate, they think if they're not calculating in state income tax, they might think it's 22% on that effective tax rate of that conversion. Okay, but when they add in that state income tax, they're up to 28.27%. So they might have been in a situation where, again, the 22% and converting at a 22% rate made sense, but does converting at 28.27% still make sense? Now, if they're staying in Wisconsin, if they're staying in the same state, things are going to equalize out on the back end unless Wisconsin drastically changes their state income tax code. Okay, if they're going to be in the 22% later, they're still going to have that 6.27% later on as well. So the math stays pretty simple if they're converting and staying into that state. But if they're planning on moving to Florida that has no state income tax, does it make sense to wait for that conversion? Because again, they'd basically be eliminating this extra almost, let's call it $5,650 in taxes. Okay, and again, this is going to be different for everybody. There are a lot of things that factor into this. First off, how long until you're moving? Okay, if you're 60 and you're planning on moving when you're 65 and you need to be performing conversions, you may need to, by necessity, just start conversions, maybe smaller conversions in that state where you're going to be paying that state income tax. Okay. Second, what is the tax rate difference? I just showed an example where the state income tax was 6.2% living in Wisconsin. But if you're living in a state like, let's say, Indiana, they have a flat income tax, which I believe is 3.23%. So at that point, that's a much smaller tax rate difference. Okay, so again, that will factor into your decision making, especially when you factor in as well. Keep in mind that the Tax Cuts and Jobs Act is expiring in 2026. So in 2026, the federal 22% bracket is becoming the 25. The 24 is becoming the 28, and then stepping back a second, the 12 is becoming the 15. And so again, if the tax rate difference is small, but waiting until you move would put you after the Tax Cuts and Jobs Act, you may be better off, again, still converting even though you're paying that extra state income tax. So there's a lot of things you have to weigh here. How much will you be converting? Okay, if you're someone who needs to be converting, $2, $3, $4 million, you might just not have the time in order to wait. Because again, we've seen high growth for the last couple of years, from 2019 to now in the stock market. The stock market's grown by 26% per year. And so if we would have waited in 2019 for a Roth conversion strategy, our IRAs, what we're trying to convert, would be so much larger that, again, in hindsight, it wouldn't have made sense to wait. Okay, so sometimes starting conversions, again, even smaller conversions while you still live in that state, even to get ahead of those RMD problems, those tax problems in the future, can still make sense. How long of a conversion strategy will you be implementing? Again, if you're only able to implement a conversion strategy from 65 to 70 and you're moving to another state in 3 years, 2 years might not be enough time to implement that conversion strategy. So again, you might need to start converting at that state that has slightly higher state income taxes. And then finally, what are the state rules? And these vary widely. This is where it gets the most complex. So every state has a different rule. The most common rule is 183-day rule. Basically what this means, and this is typically when you're most subject to it when you're going from a state that has a state income tax to a state that doesn't have a state income tax. And the state that has an income tax, they're subjecting you to this 183-day rule. And so basically what they'll look at, okay, let's just use an example. Let's say you're going from California to Texas. So you're going from a state with high state income tax to a state with no state income tax. Okay, and let's say that you're going to live in California from January to October and finally move and live the last few months in Texas. Well, you might think that, okay, if I just wait to perform my conversion when I'm in Texas, I should be fine. That should be on Texas's state income tax for that year, and I should be able to eliminate California's state income tax on that conversion. Well, that's not how it works. Most, again, states subject you to this 183-day rule, where if you spend at least 183 days or half the year in that state, they will consider you a tax resident. So that conversion, when they would have performed it, let's say in November, they would have actually owed California state income tax on that because of this 183-day rule. So keep that in mind as well as you're thinking about the timing of when to move. Finally, some other states, and again, I said this varies widely, so look up your state's rules, but some states like Wisconsin have partial year residents, meaning they don't have that 183-day rule. They basically say when you're in Wisconsin, okay, any distributions that you take in Wisconsin, we're going to subject you to Wisconsin state income tax. When you move and start taking distributions or Roth conversions, you're going to be subject to whatever state you move to at that point. So they have this partial year residence rule. Okay, so that's something where, again, take that same scenario, January to October, you're living in Wisconsin, and then the last few months you move down to Florida and perform that conversion. Well, that conversion then would be on Florida's tax residency, their tax statement, if you will, that you would have to file with Florida. So these rules vary extremely widely. So again, all of these come back to, though, the need for a forward-looking plan. What is a forward-looking plan? Well, if you're a retiree that waits till the end of the year and takes a shoebox full of receipts into your CPA and goes, what can you save me? How can I save on taxes in the future? This is the worst time to start planning for taxes. I guarantee you will be leaving enormous amounts of money on the table because of this. You need what's called a forward-looking tax plan. CPAs typically can't build these, some can, but basically it typically has to come from your advisor, because this is the person that is investing your money. This is the person that has the best idea of what your financial picture looks like now and going forward into the future. And so as you can see on the screen, this is a tax graph from a forward-looking tax plan. And again, we run this under multiple trials, so this is just one trial. But as we can see here, this person is bumping up into the 22% bracket early on in retirement, and then we see these green bars later are RMDs. So we can see just right off the bat, RMDs push them from one bracket up into a second bracket. And so this is someone that absolutely needs Roth conversions, and they really only have what looks like 5 years to perform these conversions. And so again, this will matter significantly as you're figuring out when to perform these conversions in relation to moving to another state. This person specifically probably doesn't have the time to forego a Roth conversion for a year or two if they're moving to a more tax preference state. They might just need to bite the bullet and still perform that conversion in order to save on taxes later on. Now again, everything is relative. So they might perform conversions to an extent, and going above that might not make sense anymore. So again, this is a fine line. This is why a forward-looking tax plan is that important, to know what is my marginal rate in the future. So what does it make sense to convert at today? Does it make sense to convert with that extra state income tax if you're moving to a state with lower income tax? Again, things to make note of. If you are moving, document where you lived and when. Okay, if you're moving from the beginning, from somewhere in the year you're selling a house, make documentation, because that might come back to you at tax time. Sometimes if there's discrepancies, you may get audited by the state. So that documentation is going to come in handy. Okay, some states are fairly lax on these rules, while other states are fairly strict. So again, have an idea of what state you live in, how lax they are, how strict they are. Every state's rules can vary. They can vary further moving forward in the future. Use professional help, and more important, experienced help. Okay, and finally, enjoy your new state. Okay, again, tax planning matters, but again, enjoy your new state. If you're moving to a state that's warmer, if you're moving to a state where you're closer to family, enjoy that. Okay, that's what the whole point of retirement, but make sure this is incorporated into your Roth conversion plan. Always remember, you don't need more money, you need a better plan. Hopefully this was informative. Let me know if you have any questions below. Let me know if there's any topics that you want to see in relation to Roth conversions that you want us to talk about going forward in the future. Thanks for watching. Don't forget to hit the subscribe button. Bye.